Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at SELLAS Life Sciences.
If you find our talks useful, please consider subscribe, like, and comment underneath because, well, today we are getting into something that is, frankly, a pretty wild ride.
Yeah, wild is definitely the word for it.
Right. I mean, imagine you plant this oak tree, right? You expect it to grow a steady inch a year, maybe, and instead it just shoots up 200 feet in 6 months.
Which is terrifying and exciting at the same time.
Exactly. And that's traditional wealth building versus what we are seeing right now in the world of clinical stage biopharmaceuticals. So for you listening, our mission for today's analysis is to figure out if SELLAS, this microcap that has just exploded, rallying over 200% in the last 6 months alone, is just, a speculative retail bubble.
Or if it's a fundamentally sound, event-driven trade.
Right. And to do that, we have to start with the foundation, which is just financial survival. Because before we can even look at the science, we have to look at the bank account.
Oh, absolutely. The bank account is usually the primary failure point for companies in this space. I mean, clinical stage biotechs are just notoriously cash hungry.
So expensive.
Yeah, moving a drug through a pivotal phase 3 trial costs tens of millions of dollars. And the cash burn typically accelerates the closer you get to the finish line, because of data management, regulatory stuff.
Keeping the trial sites running.
Exactly. All of that adds up incredibly fast.
And I'm looking at their revenue figures right now, and SELLAS only brings in about $1 million annually. And that's mostly tied up in licensing agreements.
Right, because they don't have a commercial drug on the pharmacy shelves yet.
So the obvious question for you as an investor is, how exactly does a company with essentially zero revenue keep the lights on? Like, without completely diluting their existing shareholders into oblivion?
Well, the answer there really lies in the severe financial discipline the management team is showing right now. If you look at their fourth quarter 2025 earnings report, it was a massive beat.
Yeah, they posted a loss of just 5 cents per share.
Right, and the analyst consensus was projecting a 7-cent loss.
Which is huge. In this sector, outperforming consensus by over 28% isn't just, a rounding error.
No, it's a massive margin. And I'd argue it's even more impressive when you look at the year-over-year data. That 5-cent loss represents a 37.5% improvement from the prior year.
Wow, narrowing the loss by nearly 40%.
While simultaneously advancing a global phase 3 trial, it just proves they are aggressively controlling their cash burn. They're running a very lean operation.
Basically pinching pennies where they can. But looking at the actual balance sheet today, the metrics are honestly surprisingly strong for a microcap. I mean, they have a debt-to-equity ratio of 0.01.
Essentially zero debt.
Zero debt.
Sure.
And their current ratio sits at 8.3. So if you're analyzing the risk profile here, a current ratio of 8.3 means they hold over 8 times as many short-term liquid assets as they do short-term liabilities.
Which minimizes those immediate solvency risks that usually just plague smaller biotechs. They aren't facing impending bankruptcy at all. In fact, as of early 2026, they have a pro forma cash position of over $110 million.
Which is a formidable war chest. But there's a really critical nuance in that number, right? Because $42.6 million of that cash came in specifically during the first quarter of 2026 through warrant exercises.
And the mechanics of those warrant exercises are vital to understand if you want to gauge insider confidence.
Let's break that down for the listener, actually, because warrants aren't just simple stock purchases. Think of a warrant kind of like paying a premium for a real estate option. It's like locking in the price of a house today because you see the city building this massive multi-billion-dollar tech hub right next door.
Right.
You hold the right to buy, but to actually exercise that right, you have to hand over your cash to the company. And normally, warrant holders wait until the absolute last minute before expiration just to keep their capital fluid.
Which is exactly what makes this Q1 activity so compelling. These investors voluntarily locked up $42.6 million now, rather than waiting.
Yeah, it's like insiders putting their chips on the table right before the roulette wheel stops spinning.
That's a great way to put it. Exercising early is a massive, tangible vote of confidence. It tells the broader market that these institutional players want those underlying shares in their hands right now, ahead of whatever catalyst is approaching.
They're willing to part with the cash today.
Exactly.
Okay, so the financial runway is secured, clean balance sheet. Now we have to look at what exactly they are funding. What is the intellectual property moat that justifies locking up $42 million early?
So the mode is built primarily around targeting a specific protein called Wilms tumor 1, or WT1.
Okay.
It's a well-known tumor-associated antigen that happens to be highly overexpressed across a pretty broad array of hematological malignancies and solid tumors.
And their lead asset targeting this protein is Gallenpepimut S, which they licensed from Memorial Sloan Kettering. Let's just call it their GPS asset for simplicity.
Yes, yeah. Much easier.
This drug is in the pivotal Phase 3 REGAL trial for acute myeloid leukemia, or AML. But the key distinction here is the setting, right? It's being tested specifically in a maintenance setting.
That distinction is everything. The maintenance setting represents this distinct gap in the oncology market with very limited direct competition. Because when a patient with high-risk AML undergoes aggressive chemotherapy, they often do achieve remission.
The visible cancer is gone.
Right? But the microscopic disease remains, and the cancer almost inevitably relapses.
And that's where that WT1 protein comes in. Because even in remission, the WT1 protein is still highly overexpressed on those remaining microscopic cells.
Precisely. So the GPS asset is an immunotherapy. It's designed to train the patient's own immune system, specifically the T cells, to recognize the WT1 protein and actively hunt down those remaining cancer cells.
So it's not about achieving the remission, it's about maintaining it.
Exactly. Keeping the cancer away during that critical window when it's most likely to return.
Got it. Now that covers the lead asset, but they also hold exclusive rights, well, outside of Greater China, to a secondary asset. It's a highly selective CDK9 inhibitor.
Yes.
And the early preclinical data is showing real potency against high-risk mutations. Specifically, I think it's the ASXL1 and TP53 mutations, where existing therapies basically fail completely.
Yeah, those specific mutations are notoriously difficult to treat because of the biology. Like take the TP53 mutation, for example. The TP53 gene produces a protein that basically acts as the guardian of the genome.
Okay.
When a cell gets damaged or becomes cancerous, TP53 is the mechanism that tells that cell to undergo apoptosis, which is programmed cell death.
It's the self-destruct button for the cancer.
Exactly. But when TP53 mutates, that self-destruct button breaks. The cancer cells essentially forget how to die. They become immortal and highly resistant to standard chemo. And this is where the CDK9 inhibitor comes in. CDK9 is an enzyme that regulates the transcription of certain anti-apoptotic proteins, basically the survival proteins keeping the cell alive.
So by inhibiting the CDK9, the drug disrupts the production of those survival proteins. It forces the mutated cell back into a death cycle, totally bypassing the broken TP53 guardian.
It's a completely different mechanism of action, designed specifically for patients whose cancer has relapsed or is resisting standard treatment.
Okay, I understand the science, but I've got to push back on the strategy here for a second. We just established their revenue is basically non-existent, right?
Wow.
And they're pouring all this capital into highly complex trials. Aren't they putting all their eggs in the acute myeloid leukemia basket?
Well,
I mean, how does having this second CDK9 asset actually de-risk the company for you as an investor if both drugs are treating the exact same disease?
it's a very fair question. But while both assets do target AML, they target completely different patient populations and use entirely different biological mechanisms. They are uncorrelated risks.
Uncorrelated. How so?
Well, the GPS asset is an immunotherapy for patients in remission, right? The maintenance phase. It relies on the immune system. The CDK9 inhibitor is a targeted small molecule therapy for patients with active relapsed cancer driven by specific genetic mutations.
Ah, I see the angle now. So if the FDA ultimately decides the maintenance immunotherapy doesn't work, the company still has this highly potent targeted inhibitor for the relapsed group.
Exactly. It's two distinct biological shots on goal, even if they are playing on the same field.
2 shots on goal. And having those doesn't just happen in a vacuum. It creates an environment where Wall Street has to place its bets, which is, I think, exactly what's causing this violent 200% mechanical tug-of-war on the charts right now.
Oh, the market mechanics here are absolutely fascinating. The biological pipeline explains the long-term value, but the sheer velocity of this breakout is driven by immediate intense structural dynamics.
Right, like we are seeing institutional ownership surge to 17.38%.
And that volume validates the breakout thesis. Smart money, like hedge funds and biotech-focused institutions, they don't just take a 17% stake in a microcap without conducting exhaustive due diligence.
They've looked at the clinical data and the trial design.
Closely.
We're also seeing high but structurally bullish volatility. Like After they announced some positive preclinical data recently, the stock jumped nearly 6% overnight.
Hmm.
But looking at the broader volatility, on March 17th, the stock dipped over 5% to roughly $5.07, but then immediately recovered.
Yeah, that's a classic bullish consolidation pattern. Look, when a stock returns over 200% in a matter of months, profit-taking is inevitable. You expect sharp, sudden dips.
Right.
But the fact that buyers immediately stepped in to absorb that sell-off at $5.07 indicates the market is rapidly re-rating this company, moving it from a speculative microcap to a late-stage, de-risked biotech valuation.
Establishing a much higher floor. But we have to address the most critical metric for the wealth-building context today. The stock currently has a massive short interest topping 27%.
Yes, over a quarter of the available float has been borrowed and sold short.
By traders betting the phase 3 trial will fail.
Exactly. And that level of short interest on a low-float microcap sets up a highly explosive mechanical dynamic.
It's a tightly coiled spring. It's the defining feature of this trade. If you are analyzing this stock today, you have to understand that mandatory buying is completely blind to fundamentals. If SELLAS releases positive clinical data, the stock spikes. All those short sellers suddenly start bleeding capital.
And because their potential losses are technically infinite, their prime brokers force them to buy back the stock to cover their positions.
They don't care what the company's true valuation is at that exact moment. They just need to exit the trade to stop the bleeding.
Which creates a cascading short squeeze. You have the institutional holders refusing to sell, retail investors rushing in to buy the headline.
And the short sellers mathematically forced to buy millions of shares all at the same time. That mechanical demand drives the price up exponentially, totally divorced from the actual book value.
However, and this is a big however, mechanical setups like this are inherently dangerous. Like you said, it's a coiled spring, and that energy can release in both directions.
Yeah, before we get to the catalyst dates, we responsibly need to examine the bear case, because the risk of catastrophic failure is always present in late-stage biotech.
Always. It is the defining risk of the sector. The primary existential threat here is the failure of the phase 3 REGAL trial.
Right.
If that trial misses its primary endpoint, meaning if the GPS asset does not statistically improve overall survival for those maintenance patients compared to the control group, the stock will suffer a severe, immediate, and potentially unrecoverable drawdown.
It's a purely binary event.
Exactly.
And, there are heavy valuation concerns being raised by traditional analysts right now, too. Weiss Ratings recently issued a sell rating for the stock, a D- rating, to be exact.
Right. And their downgrade is grounded in traditional asset metrics. They cite a sky-high price-to-book ratio of 12.42.
Okay, wait, let me jump in here and push back on the overall bullish sentiment we've been talking about, leaning heavily into this Weiss downgrade. If the price-to-book ratio is already sitting at 12.42, hasn't the market already priced in a perfect phase 3 result? I mean, investors are paying over 12 times what the company's hard assets are worth today. Are we essentially looking at a scenario where buying now means buying at the absolute top?
I hear that argument constantly, but honestly, applying traditional price-to-book metrics to a pre-revenue clinical stage biotech is like judging a software startup by the resale value of its office desks.
That's fair.
It completely misses the point of the investment. The value of SELLAS isn't in their current hard assets or laboratory equipment. The value is entirely contained in the binary outcome of the phase 3 trial.
So traditional valuation metrics are essentially useless here.
They are notoriously clumsy. A single FDA approval for a novel oncology drug changes the book value overnight by hundreds of millions, sometimes billions of dollars.
Because the market is pricing in future cash flows.
Exactly. The cash flows of a commercial stage AML therapy. But your core point does remain valid. A significant probability of success is already baked into the current share price.
Right.
If the data is merely okay and not definitively stellar, the stock could still drop because perfection is what the current valuation demands. The floor is very, very low.
Which means this battle between the massive upside potential, like the $10 price target we've seen from Maxim Group, and the severe downside risk, is going to be decided imminently. The clock is actively ticking. So let's map out the exact timeline for you, the catalyst calendar.
Yeah, because the entire thesis here is a classic event-driven trade. This is not a passive multi-year accumulation play. It's a tactical position that resolves over the next 3 to 6 months.
So let's start with the near term. What is the first domino to fall?
In mid-April 2026, The American Association for Cancer Research, or AACR, is hosting their annual conference. SELLAS will be presenting preclinical data highlighting the potent activity of that secondary asset, the CDK9 inhibitor.
So that serves as an immediate sentiment driver. It keeps the stock in the financial news cycle, maintains the high trading volume, and provides further validation for that secondary pipeline.
Right. It proves they aren't just a one-trick pony.
But that is ultimately just the appetizer.
The main course is imminent. In the second quarter of 2026, we get the ultimate binary catalyst, the Phase 3 Regal final analysis.
And the phrasing the company uses here is critical. The data readout is due any day now. Why? Because 72 out of the 80 required survival events have already been recorded.
And just for context, a survival event in an oncology trial protocol means a patient enrolled in the study has unfortunately either relapsed or passed away.
Right.
The statistical design of the Regal trial requires exactly 80 of these events to occur before the Independent Data Monitoring Committee can unblind the results.
And compare the GPS group to the control group.
Exactly.
Meaning the data isn't waiting on a laboratory experiment to finish. The outcome is essentially already locked in the biology of the patients currently enrolled. They are literally just waiting for those final 8 events to happen so they can open the envelope.
And because the timeline is entirely dependent on biology, it cannot be precisely scheduled. It could trigger next week, or it could trigger in 2 months.
Synthesizing this timeline data, I want to deliver a clear strategy regarding the mechanics of this play. Because 72 of the 80 survival events are already in the books, this is not a buy and hold for retirement stock.
Definitely not.
It is a high-alert, tactical wealth-building play where timing the binary catalyst is everything. You are positioning yourself specifically for the volatility surrounding the opening of that envelope in the second quarter.
And you have to remember that the 27% short interest we discussed is acutely aware of this timeline. Those short sellers are watching that survival event ticker just as closely as the institutional buyers.
Oh, absolutely.
The tension between the bulls holding for the data and the shorts trapped by the impending release is at its absolute maximum right now.
It's a high-stakes standoff, which actually leads me to one final highly logical market dynamic for you to ponder. With a pristine balance sheet, zero debt, and a late-stage oncology asset that is days or weeks away from a pivotal Phase 3 readout.
Yeah.
SELLAS is fundamentally a prime acquisition target.
Well, the macro environment certainly supports that theory. Mergers and acquisitions are the lifeblood of the broader pharmaceutical sector right now.
Right, because the larger pharmaceutical giants are facing massive multi-billion-dollar patent cliffs over the next 3 to 5 years. Their blockbuster drugs are losing exclusivity.
Yeah, they are desperate to pad their hematology and oncology pipelines to replace that lost revenue.
And they have billions in cash sitting on their balance sheets. And here is a microcap company sitting on a potentially de-risked late-stage asset.
While it remains speculative, the sector trend strongly favors big pharma buying out late-stage assets and utilizing their massive global distribution networks rather than spending a decade developing novel therapies in-house from scratch.
So here is the provocative thought I want to leave you with today. What happens if a big pharma giant tries to buy them out right now at a strategic discount before that final Phase 3 data is even published?
Wow.
Imagine the sheer panic from the short sellers if an acquisition is announced at an 80% premium tomorrow morning. The shorts wouldn't just be squeezed by positive data, they would be trapped by a corporate buyout. It changes the entire calculus of the coiled spring.
It's a fascinating, highly disruptive scenario, and it perfectly underscores the high-risk, high-reward nature of this specific event-driven setup.
It absolutely does. We started this discussion talking about the comfort of traditional investing, planting an oak tree and watching it grow. But when you are dealing with a 27% short interest, zero debt, and imminent Phase 3 cancer data tied to 80 biological survival events, you aren't waiting for seasons to change. You are watching a fuse burn down.
Yeah.
The countdown has already started. The only question left is the trajectory of the outcome. Keep your eyes on the data, understand the mechanics of the trade, and we will catch you on our next talk.